Let me ask you something sharp. What would your business look like without the taxman, depreciation schedules, and financial hocus pocus? What if we stripped it down to the raw operating engine? No IRS adjustments, no paper losses, and no accountant magic. That's what the EBITDA margin is all about. And if you're not tracking this number, you might be fooling yourself into thinking you're not profitable, when in reality, you're just letting the paperwork cloud the truth. So what is EBITDA margin? It's calculated by taking your EBITDA divided by your revenue. So let me clarify that. What is EBITDA? It stands for earnings before interest, taxes, depreciation, and amortization. Translation: it's the money your business makes from operations before the bank, the government, or your CPA gets involved. So if you bring in $1 million in revenue and your EBITDA is $120,000, $120,000 divided by $1 million is 12% EBITDA margin. That's your clean operating profitability. No fluff, no write-offs, no "we lost money on paper" excuses. So why does it matter? Because EBITDA margin strips away distractions and shows you how well your core business runs. You could be depreciating equipment at $40,000 per year or writing off interest on a building loan. None of that changes the fact that your jobs, team, and ops are either producing margin or they're not. EBITDA margin is the "can we survive and grow" number. And if it's weak, no amount of tax tricks will save you. So what is a healthy EBITDA margin? Here's some benchmarks for construction businesses. 15% or more, that's pretty strong. You got solid systems and tight cost control. If it's 10 to 14%, well, that's pretty respectable. You're operating clean, but have room to improve. Between 7 and 9%, you're getting there. Overhead and cost creep is likely hiding in the walls. If it's below 7%, it's time to diagnose. You're working hard to stay average. And yes, some GCs might survive on 5%, but long term, that's too tight to breathe. So let me give you a real example here. I had a contractor come to me saying, "I don't understand, we're showing a net loss, but we've got cash." So we ran his EBITDA number. Revenue, $3.2 million, EBITDA, $365,000, margin, 11.4%. Solid. The business was operating profitably. But depreciation from a fleet purchase and interest from a loan on the office building, that was dragging net profits into the red on paper. His ops were working. His accountant just made it look like they weren't. Once he understood his EBITDA margin, he could start managing from strength, not confusion. So here's how you can improve your EBITDA margin. Number one, tighten your cost structure. Improve your labor efficiency. Dial in material management. Track and adjust estimates in real time. Number two, watch your vendor terms and rates. Overpaying from subs and rentals, that's money leaking out the back. Number three, track job profitability as it happens. Don't wait until the final invoice to realize you blew the margin. Number four, control SG&A, or selling general and administrative expenses. That office fridge and satellite radio add up. Number five, don't rely on tax write-offs to feel profitable. If you need depreciation to break even, your ops are underwater. So here's the final word. EBITDA margin tells you if your business is actually profitable before the paper trails confuses the story. It's the numbers investors care about, banks care about, and frankly, you should care about too. Because if your EBITDA margin is strong, you got a business you can grow, fund, and even sell one day. If it's weak, no tax deduction or a clever amortization schedule is going to fix that. So ask yourself, is your business truly profitable, or are you just surviving on write-offs and accountant magic? Strip it down, check your margin, and build something real.